Welcome to this Killick Explains video, and welcome to a hardy perennial topic which it's worth revisiting right now, given what's happening in markets around the tail end of 2025, September, October. And that is how to manage stock market cycles and harness, not to be frightened by, in brackets, volatility. All right, the two go together. So, with no more ado, I like to open with a quote, and here's one from Warren Buffett, who recently retired from being CEO of the company he founded, Berkshire Hathaway. And what he said was, volatility is the price for admission. All right, into what? The prize is superior long-term returns. You've got to pay the price to get the returns. So his point, and he made lots and lots of sort of famous quotes around volatility. His point is, volatility is not something to be scared of. It's not something to be frightened by. It's something to be managed, and it's something that will generate those long-term returns we tend to associate with equities rather than, say, cash deposits. So with that in mind, stock markets can be volatile over the short term. All right, they go down as well as up, hence the regulator's warning. Okay, past performance isn't necessarily a guide for the future. That warning is there just to say you cannot, unlike a cash deposit, rely on tomorrow being exactly the same as today. That is the nature of stock market investing. All right. However, the reward, if you know how to deal with this volatility, as it's called, is potentially long-term returns. All right. But there are a couple of key rules you need to know in order for it not to go wrong, in order for you to capture those returns through what are called changing market cycles. Now, with no more ado, what does volatility actually look like? For anyone thinking, what's he talking about? Let's take one of the best known indices in the world, the big American index, the S&P 500. If we were to look back, now it may be a little bit small to see this, but down here, I've gone right back to the mid 1960s. That says 1965, if you're squinting to see it, all the way up to basically now. For anyone wondering what it says there, 2025. So it's just got a long-term chart of the main index in the US, representing the top 500 companies by value. All right. Now, why am I showing you this? What is volatility, for anyone not sure? Doesn't look like there was much back here in the 70s. That would be a bit of an illusion. I'm going to come back to this section, the 70s, in a moment. It looks essentially flat. That's because of the way the graph's been put together, logarithmically, if you like. But over here, you can see, look at that. There's the dot-com crash for those people who can actually see the chart. You can see the dive there. Then we've got the financial crisis, another big dip. If you look at what's happening to the line there, move on up here and you start to hit pandemic and Donald Trump's Liberation Day. In other words, these events that cause the market to drop quite sharply. And if you think it doesn't look that bad, I'll give you some of the drops as a percentage in just a moment, and you'll see what I mean. So as an investor, the good news is, past is no guide to the future, it says at the bottom, but if this pattern continues, overall, the market has climbed magnificently over this very long sweep of history. But in order to get from there over to there, you have to put up with some quite big bumps along the way. Now, let me just clear this away and let's just zoom in on this part down here. So how bad can it be? On the chart I just showed you, just reiterate that. Well, if we go all the way back, so here you go, here's a zoom in. There's 1970, all right, hopefully more visible. There's 1980. Go back to this decade. All right, things started to go wrong. The S&P 500 is like a cutout from the last graph. All right, and this is, by the way, if you're wondering why I've gone back to the 1970s, this is one of the big ones. This is the worst one we've seen since I've been alive, for sure. This was quite a nasty drop. All right, the market lost over 60% of its value. All right, and if you're following where the line goes, it took 8 years to recover. All right, so that's as bad as it can get, but that is as bad as we've seen. All right, so 2 points to take away. Big dips happen, but wouldn't it have been a terrible mistake to have dumped all your stocks in a fluster right there? Because the market it took a while, climbed back up, it wobbled its way back up to a point where you hadn't lost anything if you stayed invested. And that's the point I want to reiterate in just a moment. Okay, so let's for anyone thinking 1970s, let's fast forward a bit. So let's look at some of the bigger drops as numbers instead of on a chart, for those people who missed the chart or were squinting at it. So there you have it, the 1970s inflationary oil crisis. For anyone who remembers that, won't be everybody watching this, 60% drop in the market. That's pretty terrifying. And it took 8 years to recover, in case you're wondering what I'm showing you here. Okay, we can fast forward. Dot-com crash, last big tech crash. Market lost 50% of its value, took 6 years to recover. All right, 2007, 2009 financial crisis, lost 50%, took 5 years to recover. Pandemic wave 1, now here's an interesting one, dropped a third. Boy, bailing out then would have been a mistake. Took only 6 months to recover. All right, so pretty frightening drop, but pretty fast rise. 2024, so-called Liberation Day. All right, a 12% drop. I picked one of them, and just a month later, the market had recovered. Right, so this is an important message. Yes, volatility can be pretty terrifying. Now, it isn't like that every year, quite clearly. Drops of 10% are much more common, but you can get big ones. But every single time, and the worst case has been 8 years, which I admit is not nothing, the market has recovered. Now, here's the point. When the market dips, and you're probably guessing where this is going, do you sell up, wait and buy back again? So there'll be some clever people out there thinking, aha, if I think a dip's coming, what I'll do is I'll liquidate, I'll wait, and I'll buy everything I owned yesterday cheaper tomorrow. Or I'll just panic and sell up and buy back when I feel more comfortable. The problem with that approach is twofold. Number one, how do you know when to go back into the market? All right. And number two, in the meantime, what if the market recovers quicker than you expected? And there is some data, some science that shows, JP Morgan did a big study, that if you miss the big corrections upwards, so in other words, the way investors tend to behave is you get big drops and then big bounces. If you miss one of those bounces because you're not paying attention, sitting on the sidelines in cash, it can really hammer your subsequent returns. It can halve them over a period of 20 years, for instance. So it's pretty tricky. Market timing is not something I would recommend. Are we going to sit tight? That's a better bet. The most aggressive investors will not only sit tight, they'll look to buy stocks as they get cheaper. Okay, not dump their whole portfolio, but just buy it as they get cheaper. And the point about market timing, liquidating everything, either trying to be clever or because you're panicking, it doesn't work. Doesn't work out. So the two big traps. There's another one, by the way. Panicking is one. Let's assume you're not being clever, you're panicking. The other one is being put in a position where you have to sell shares at just the wrong moment because you've got no choice. And I'll come back to both solutions next. Now, to minimize panic, okay, set yourself up so you're not constantly following the headlines. You're not constantly checking your app. You're not sitting there sort of nervously fidgeting, wondering whether to hit the sell button. Try and resist that urge. Systematically review your portfolio once every 6 months, for argument's sake. Or even better, arguably hand it over to somebody else so you're not constantly worrying and fidgeting with it, all right? Drip feed money into the market. I've covered this in other videos. You get the benefit of pound cost averaging, which is a flash way of saying if you drip money in every month, rather than wonder whether you pay it in today, tomorrow, next month, you get the benefit of buying in the dips, as it's called. Other video references coming up for that one. And cover your future cash requirements so you don't put yourself in a position of having to sell shares at just the wrong moment. Now, for that last point, you need a 3 pots approach. And I have covered this elsewhere, but this is the way to set yourself up so you're not suddenly one day having to liquidate shares just as the market's going through a difficult phase and forcing losses on yourself, if you like. So 3 pots is number 1, create and manage a rainy day fund. Bit more detail on these coming up. Number 2, get a plan together for those large capital outflows you know are coming up in the reasonably near future. These are not emergencies, these are planned outflows. And then you can invest the rest in the stock market and not have to worry about panic selling or doing any selling, because it can just sit there, going through thick and thin, through good times and bad, generating those cumulative long-term returns we get through the power of compound growth. All right. So this is what I call the structured 3 pots approach to your investing life. Now, back to rainy day funds for a moment, back to item 1 just there. So you do need an emergency fund, and it's not going to be in shares. It's going to be in something more like cash. It is there to cover illness, accidents, and unemployment. All right, it's a cash reserve. And if you're wondering how much, good question, does depend on the individual. But if you're single, 3 to 6 months of your gross monthly spending. If you're responsible for a family, I personally would make it more like 6 to 9. All right, but it depends on the person and on their sort of risk appetite and so on as to exactly how many months you set aside. Also depends if you've got to buy a wedding ring, presumably between now and that emergency happening. Right, on to foreseeable calls on capital. Now, people say, well, that's a grand sounding title. What are those? This is setting aside money, all right, not in equities, we haven't got to equities yet, for things that are coming up which require a lot of capital. So these are not emergencies, these are things you actually know are going to happen. School fees paid in advance is an example. So is buying a second property, if that's a thing you're able to do, funding a wedding for a child, for argument's sake. These are quite big amounts of capital potentially, and you do know they're coming up. People say, I don't. Yes, you do. Children start secondary school at 11. As far as I know, none of them get around that rule unless they're being homeschooled or something. So you do know when some of these outflows are coming up, and therefore you can make a best estimate. Okay, so there are some things you need to think about how much might be required. And what we're going to do is potentially put that money into something which is a bit better than cash, because cash doesn't earn great returns, but not equities. So gilts, possibly corporate bonds, for argument's sake. And then the rest we call lifetime savings, but the rest basically we're going to invest in equities. Now, there's some structure around this, there's some science. I won't go into all of it here. Other videos cover it, my guides, which I'll reference at the end. But we're going to create a plan and a cash flow forecast. We're going to map out how our future looks in terms of income and expenditure. Okay, we're going to focus on building up so that we can then draw down on peak savings. Most people don't follow a sort of 40-year career and then get a carriage clock from one employer. They work in all sorts of different capacities, freelance, full-time, part-time. But what we're going to do is set a target at the point where basically we might want to be drawing on our savings as opposed to building them up, called peak savings. And we're going to review and reset regularly. But the point is, what we're going to do is get the money that's got to do all this to work where it stands a chance of following that big graph I mentioned earlier and increasing in value through compound growth over time. So get rid of those scribbles and almost there. What we're going to need to think about. So I've made it all sound quite easy and scientific so far, but in fairness, this is where people do quite rightly want some help sometimes in order to build that cash flow forecast map. All right, judge peak savings and so on. We're going to need to make assumptions about for future income, future outgoings, the future rate of inflation. Take an educated guess at that. We know the long-term UK rate, for argument's sake, historically, and rates of return on our investments, because we're going to want to maximize those, but taking account of our attitude to risk. Some people are risk averse, some people are not. All right, and where we are in the current market cycle. If you think about that chart I showed you earlier on, the stock market is cyclical. It goes up and then it sometimes does a loop and then goes up again, does a loop, goes up again. So it's important to make sure you know roughly where we might be in the current one. Now, enough from me probably at this point. If you're wondering where those other videos are, I mentioned killick.com/resources. You can also find my how-to guides there. Those are really useful on some of that lifetime planning, cash flow forecasting stuff I mentioned. And we've got a quarterly magazine, Confidant, where some of this stuff is revisited live, as I just mentioned, once a quarter.